Hello, everyone. I'm Noah Lui, Head of Investors Advisory at RHB Bank. Welcome to this special podcast episode with our Chief Economist, Barnabas Gunn. Today, we'll tap into his view on the current geopolitical tension involving the US, Israel, and Iran, and discuss the potential spillover effect on oil, gold, and global equity markets, including what it could mean for Asia and Malaysia. Hi, Barnabas. In your view, what's the latest progress in the conflict and what are the 2 to 3 signposts that you are watching to judge whether we are moving towards a de-escalation or a more prolonged regional escalation?
Yeah, hi. Thank you for listening in. So I think generally, if we look at the current global risk appetite, it has declined, and it's really largely due to the increased geopolitical tensions that is being seen in the Middle East. Several goalposts or yardsticks that I look for, that might derail, or re-anchor global risk appetite will be, I think, primarily the outlook of the Hormuz Strait, whereby 20% of global oil supply actually goes through. I'm looking at that very closely, and any stoppage, or blockage of this Hormuz Strait, which is vital for supply chain conditions, will likely mean a further escalation of risk of poor risk appetite, and that might also lead to more expensive oil prices, and the deterioration of global risk confidence, not for that matter. Second, probably it's another key piece of evidence that might keep me awake at night will be on the potential collateral damage across the Middle East, and further escalation of various nations within the Middle East itself contributing to the conflict, and any further escalation, be it whether the length or severity of the tensions, will be vital to looking at how it might develop, into the coming weeks or months again.
Well, but when it comes to the oil price, what is the market pricing in now for the oil, and what specific development would make you shift from elevated risk premium to a more extreme scenario, potentially towards a US 140 per barrel? How should we think about the Hormuz and the shipping channel versus the actual supply loss?
So I think the worst case outcome will hinge on two factors. First, the severity, and second, the duration of the current tensions. So for the matter, a prolonged and escalation standoff would be the key risk, because sustained uncertainties could drive oil prices materially higher. And a clear reference point is the Russian invasion of Ukraine back in 2022, during which oil prices actually spiked as high as $140 a barrel on an intraday basis. So this basically underscores the potential for a similar move, and especially in the current uncertainty, should current conditions deteriorate. One key point really is the Strait of Hormuz, whereby it remains to be a critical choke point, and any destruction or closure would likely mean, an earliest and strongest signal for the matter for further upside pressure on oil prices.
Assuming the oil price stay elevated, what is the magnitude of inflation passed through in ASEAN, especially Malaysia, and its implication to their economy?
So I think the general understanding really is that the direct impact on Malaysia from the ongoing tensions in the Middle East is actually expected to be limited. And some of the numbers basically show this. For example, the trade with Iran, with Malaysia, accounts for only 0.1% of total trade of Malaysia's trade, while the tourist arrivals also made up only 0.2% of total tourist arrivals. So it's a very small exposure that Malaysia has, to Iran. But if you just look at the Middle East as well, similar low exposures can also be seen. The total trade of Malaysia with the Middle East region accounts for a very small 4% of total trade. And tourist arrivals is about 1% over the last 5 years. So I think generally, given the escalation, probably the direct impact is going to be limited. We still maintain Malaysia's GDP growth at 4.7% for this year, with the upside bias towards 5. Yeah. And growth is likely to be underpinned by the continued strength in the domestic demand, robust external demand, as well as supportive government policies in place, at the moment.
Besides Malaysia, is there any other ASEAN country that is more impacted or less impacted? Could you add on that?
So Malaysia is special. Yeah, thanks for the question. But Malaysia is special because Malaysia is a net oil exporter. But across ASEAN, ex-Malaysia, say Thailand, Indonesia, and Singapore, given that they are net oil importers, then that basically brings out the concerns of higher oil prices that might detrimentally affect producer prices within this ASEAN countries itself, and that would mean a translation into consumer prices that might stay elevated just from the basis of higher oil prices. And especially for Singapore, in fact, because it's a small and open economy, the direct impact from our own correlation analysis basically suggests that the higher oil prices has a very strong direct impact, a correlation of 0.9 to be precise, that will impact producer prices and vice versa, consumer prices. And this is probably one of the key risks that we should look at, looking at ASEAN ex Malaysia.
Okay, thank you. Moving on to the asset that our investor is holding, including equities and also gold. How do you frame the base case for gold and equity from here? What would need to happen for you to stay defensive? And what would be the green light to rotate back into the risky assets?
So I think to be clear, given the current escalation of geopolitical tensions within the Middle East, I think right now is the time to stay cautious and defensive. And to be clear as well, we are expecting a 5 to 10% decline in global equities, especially US, only under the worst case scenario, right? That is unexpected further escalation of Middle East tensions. Historically, we have seen that tensions or shocks tend to trigger risk of segments amongst global investors, resulting in reduced equity exposure. And if we could draw from past episodes, including the Iraq War in 2003, the 9/11 in 2001, or the Russian-Ukraine conflict in 2022, we do observe that generally there is a average decline of S&P by about 7.5% by the second week of the onset of the conflict. So given just historical standpoints, we do look at a 5 to 10% decline in global equities, especially the S&P. Now, if you go to the question of gold, at this juncture, I think maintaining a prudent risk posture is highly advisable. And our core conviction is to stay cautious and defensive and to have an overweight position in crude oil and global safe haven assets. Our preferred safe havens are actually hard assets, such as gold and traditional safety instruments like US Treasuries. Gold, as its reputation suggests, has historically performed very well in periods of heightened stress, and particularly right now, even though it's broken above the $5,000 a handle. And this basically strengthens its value prospects.
Okay, coming to my last question, which is also the verdict. Given the recent correction in Asia, would you think the pullback driven by war-related uncertainty now present a good opportunity to add to Asian equity? Or would you still recommend staying diversified across both US and the Asian market?
So I think the key advice I can give our listeners here is to stay cautious and defensive, but don't be too quick to sell off. It's actually to stay neutral. It is important to note that a quick resolution may mean a rapid normalization of market sentiments, and this will allow global equities to re-enter to strong underlying economic fundamentals and hence reduction of safe haven demand over the course of time. And for now, given where we are, we do observe and we recognize that the current volatility reflects geopolitical stress rather than weakness in the general global economic status. So right now, as we speak, probably a diversification across US and Asian markets still remains to be the key strategy at hand. With even though the S&P falling and the ASEAN stocks markets already declined quite significantly at this course of time. But I think one key advice I to also give is that the decline, especially the Asian stocks, does present a buying opportunity, especially on the assumptions of a quick resolution. So that could be one of the key strategies that we can adopt post the conflict into 2026.
Barnabas, thank you for your sharing Today, investing is dynamic, and as the saying goes, when the facts change, I change my mind. Stay updated with the latest market insights from RHB Bank and keep your portfolio well diversified. If you'd like to have a review in line with your goal and risk profile, please reach out to your relationship manager. Thank you and see you again in our next podcast series.